again, I try to ban this topic because it's an emotional one. It's like talking about religion. It's like talking about cryptocurrencies, right? People end up on these totally irrational. So listeners, come into this, please, with an open mind, and try to understand and be objective. I'm a quant, right? There's no emotions here. I have no heart. So
I always joke and say it's negative interest rates, crypto, and stock buybacks are the three most religious things in finance.
All in one. All right, let's start with the basics, and then we'll go from there. You're a company. Doesn't matter if you're public, private, whatever. Let's use a public company, say you're Apple. There's only 5 things you can do with your money, and that's it. The first one, which is what people spend 90% of the time on, is the sexy part, is you can reinvest in the business. That means you're building new plants. You're doing research into a new computer. You're hiring new people. You're doing new innovation, right? That's one. Second, you can go do M&A. You can buy other companies, which traditionally is actually value destroying on average. But you can go take over other companies, add to your company to the extent you have cash. So that's one. So 1, reinvest in the company. 2, M&A. 3, to the extent you have debt, you can pay down debt. And then the last 2 are ways you return the cash to shareholders. You can pay a cash dividend, or you can do a stock buyback. That's it. There's nothing else you can do with your money. And the job of a CEO, who, by the way, most of these guys are not dummies. They may be egomaniacs, but they're not dummies, is to pursue any project that has the highest return, okay? And so let's say you're at Apple and you have a great idea for a new teleporter, and it's going to be awesome. Good for you. Put that money there. But if you're a widget factory making widgets and you don't have like any brilliant ideas, but you're sloughing off billions of capital, what are you supposed to do with that? And you can't just, so most people, you say, well, you could just go hire a bunch of people and do all this R&D. Well, you're just flushing money down the toilet if you don't have ideas that are reasonable. And if you get to a certain size, it gets harder and harder. If you're a $100 billion company, if you're a $500 billion company, these are the old kind of bloated companies. You can't do anything with that much money. So what have they done historically? They go do M&A and also flush it down the toilet. They name stadiums, flush it down the toilet. So the long history, by the way, you go back hundreds of years, is that the original reason companies had dividends is because when you were selling securities to the public and institutional investors, you had to try to make them a little more like bonds. Like, hey, you can buy this company and it'll pay you some sort of like cash return, like interest, okay? And it's returning cash to shareholders. And so that was the concept. But buybacks, this is going to trigger everyone, but this is finance 101. This is something you should have learned as a freshman in college, is that buybacks are the exact same thing as dividends, with only 2 differences. Buybacks are more flexible. You can do them whenever you want or stop them. They're more tax efficient. Dividends have a worse tax treatment because you're forced to take them every year when the company pays you. So you have to have money back whether you want it or not. And then buybacks can also happen at a distance from intrinsic value for the company. And that's it. So if the company is trading, a stock's trading at intrinsic value, and let's say theoretically politicians did this, they never will, they have the same tax treatment. They're literally the exact same thing. And that's full stop. Okay, you cannot argue that fact. That is a 1 + 1 = 2 theorem, okay? So one way to establish if a writer or a guru or someone doesn't understand buybacks is to look at what they just said, take out the word buyback and put in dividend. And if the sentence doesn't make any sense now or it changes the message, well, then they don't understand, or they're conveying the meaning, or they have an emotionally charged agenda, okay? Let's talk about a few more things. By the way, not everything is rosy about buybacks, and we'll get into that. For the greater experience of history, for the past 200, 300, 400 years, this goes back to the Dutch East Asia Company, or Dutch East Asia. I'm going to get the name wrong. What's the name of the company? Anyway, 1700s. It was one of those.
Oh, China,
the Dutch one. O'Shaughnessy and others, we have on our blog post. I got so frustrated with this topic. We have a blog post that's called FAQ on buybacks for journalists, politicians, etc. and it links about the top 10 things to do with buybacks. I actually saw a great one, flow chart last night from Josh Wolf and Michael Malbison. It's on Twitter. You can post to the show links. For the most of history, governments and investors demanded that companies do buybacks because they didn't want CEOs squandering the money, paying themselves huge salaries, doing stupid projects, hoarding it. So they said, your company, you have to pay dividends, you have to do buybacks because we don't want you to do dumb stuff. And it's funny how the dialogue has changed. So let's fast forward to the modern era. Companies have started doing a lot more buybacks since the 1980s because there's a rule that got passed in the early 80s that made it particularly easy and gave companies safe harbor from buybacks, okay? So in any given year, buybacks started ticking up. In any given year, starting in like 97, buybacks have outpaced dividends, as they should, because they're more tax efficient, okay? Now, there's two parts and there's two separations. There's the talk about buybacks and dividends from an investor standpoint, which we can get to in a minute, and then there's buyback and dividends from a public policy, et cetera. Why do buybacks have a bad name? First of all, they got terrible branding. Whoever came up with the name stock buyback should be fired. You know, such like you talk about like how everyone buys life insurance. Back when it's called death insurance, no one would buy it. The same guy, the Chilean toothfish, when he named it Chilean sea bass, all of a sudden everyone buy it, all right? So buybacks is a terrible framing for it. What it should be called is flexible tax efficient dividends, okay? Warren Buffett understands this, right? Look at Berkshire. Berkshire has never paid a dividend, and that's not quite true. It paid one in 1960s. It was like 10 cents. And Berkshire famously, Warren says he was famously in the bathroom when they made this decision because he would never have made that decision. Because dividends force you to take cash back. Buybacks don't. You can choose to or not. The things that I think are probably fair. Many people associate buybacks with CEOs and compensation. And they say, well, these CEOs, they have compensation tied to earnings per share. They have options. Therefore, their only goal is to increase earnings per share. Thus, they're doing buybacks, yada, yada. Those are two separate issues. If you have a dipshit board that is tying CEO compensation to earnings per share, they should be fired. Full stop, right? That has nothing to do with buybacks, okay? How you distribute cash has nothing to do with how you pay your CEO and your company. In the same genre, you have to talk about companies that also issue shares, correct? So there are a lot of tech companies and other companies to reward employees. They issue stock options, all right? So that's share issuance. So you're diluting the shareholder. And on the right hand, they go and buy back the shares, okay? So it's somewhat of a wash in many cases. I think that's a fair criticism, but it's not a criticism of buybacks. It's criticism of structure and how boards operate. And that's a policy decision that has nothing to do with buybacks. Another example is people love to take a sample size of one, and they'll look at a company that has been buying back a bunch of stock over the past 10 years, and then maybe gets into hard times or the share price goes down. And they say, look how stupid that was to buy back stock, and now the share price is down. That was so dumb. They wasted so much money. But many of those companies were also issuing dividends. And you say the same thing. It's simply a return of cash to shareholders. It's the same exact phenomenon. Now, as a shareholder, you should never want to own an expensive stock. So if you're Warren Buffett, you have a quantitative measure. He says, look, we'll buy back shares of Berkshire when they get below, I think it's 1.3 times book. I think they're right around 1 now. So he's probably buying a bunch of Berkshire this year, this quarter, this month. Most CEOs don't have that in place. That having been said, if you look at the historical valuations of companies that are issuing shares, companies that are buying back stock, and companies that are buying back a lot of stock, the ones that are issuing shares traditionally are trading at valuation premiums. The ones that are buying back stock are trading at valuation discounts. And the ones that are backing up the truck and buying a boatload traditionally are trading at valuation big discounts. So on average, they've done a good job. It doesn't mean you can't come up with some company that hasn't. And then a second part is the company just poorly managed? People don't talk about, hey, they wasted a bunch of money on that new plant in upstate New York, or hey, they paid out billions in dividends. They shouldn't. They should have been paying down debt. That's a CEO decision, and whether you wanted to lever up the company or not, it's up to you. But on the flip side, a lot of companies in Europe, a lot of companies in Japan have the opposite structure where they have a ton of cash and they're just very bloated, what you call these zombie companies. All of this having been said, I'm a buyback agnostic. Doesn't sound like it, but I'm a buyback agnostic. A very simple fix to all of this is legislature, politicians, eliminate the double taxation of dividends. Okay, so you remove the tax of a company paying dividends, and all of a sudden buybacks become fairly irrelevant.